Microsoft is often seen as the ultimate safe stock, trillion-dollar tech giant deeply embedded in everyday business, leading the artificial intelligence revolution and dominating cloud computing. So when Microsoft's stock suddenly dropped and wiped out billions in market value, it caught everyone's attention. This wasn't caused by a war, a scandal, or a sudden economic collapse. It happened quietly, right after results that most companies could only dream of. And that's exactly what made it dangerous. Because in the stock market, strong performance is sometimes not enough. Expectations matter more than reality. The center of Microsoft's stock decline was the gap between what investors expected and what the company actually delivered. Microsoft reported solid earnings, strong revenue, and healthy growth across most of its businesses. But Wall Street had already priced in something bigger. The market wasn't looking for good results. It wanted exceptional, almost perfect numbers driven by artificial intelligence and cloud expansion. When Microsoft didn't exceed those sky-high expectations, even slightly, the reaction was swift. Investors sold, not because Microsoft failed, but because it didn't surprise them enough. One of the biggest pressure points was Azure, Microsoft's cloud platform. Azure is the backbone of Microsoft's future growth story, especially in the age of AI. While Azure continued to grow, the pace was slower than what investors had been hoping for. In isolation, the numbers were still strong. But in today's market, even a small slowdown in growth can trigger concern. For Wall Street, slowing momentum in cloud services raises questions about long-term scalability, competition, and future margins. That hesitation alone was enough to push the stock lower. Artificial intelligence also played a major role in the sell-off. Ironically, the same factor that helped push Microsoft's stock to record highs. Microsoft has invested heavily in AI, particularly through its partnership with OpenAI and the integration of Copilot across its products. However, AI is expensive. Data centers, specialized chips, energy consumption, and infrastructure upgrades are costing billions. Investors are now asking a critical question. When will AI start generating profits that justify this level of spending? Right now, AI is a long-term bet, but markets often punish companies when returns are delayed. Another important factor behind the decline was profit-taking by institutional investors. Microsoft shares had been trading near all-time highs, and many large funds decided it was the right moment to lock in gains. This kind of selling doesn't signal fear, it signals strategy. When expectations peak and valuations stretch, professional investors reduce exposure. Retail investors often misinterpret this as a sign of weakness, but in reality, it's a normal cycle in financial markets, especially after a strong rally fueled by hype. Interest rates and broader market conditions also added pressure. High interest rates make future earnings less attractive because money today becomes more valuable than money tomorrow. Since AI profits are expected to arrive later rather than sooner, investors are more cautious about paying premium prices for long-term growth stories. Even a company as strong as Microsoft is not immune to this shift in sentiment. When the macro environment changes, the market becomes less forgiving, even toward industry leaders. It's important to understand that this move does not indicate a fundamental problem with Microsoft's business. The company remains financially strong, with massive cash reserves, consistent cash flow, and a diversified revenue base that includes software, cloud services, gaming, and enterprise solutions. Microsoft is not collapsing. What we are seeing is a correction, a recalibration of expectations after months of AI-driven optimism pushed valuations too far, too fast. The real takeaway from Microsoft's stock drop is not fear, but perspective. The market is transitioning from AI excitement to AI evaluation. Investors are no longer asking who is leading the AI race. They're asking who can turn AI into sustainable profits. Until there is clearer visibility on margins, costs, and monetization, volatility is likely to remain. That doesn't make Microsoft weak, it makes the market more selective. In the end, Microsoft's stock fell not because the company failed, but because expectations became unrealistic. This was a reminder that even the strongest companies are judged not by how well they perform, but by how closely they match the story investors have already priced in. For long-term believers, this moment may represent patience and opportunity. For short-term traders, it is a warning that hype alone cannot hold a stock up forever.